Many people assume that the most important companies in the AI era must be the ones constantly dominating headlines and discussions. But what really determines whether AI can actually scale is not who computes the fastest, but who can move data most reliably between chips, racks, and servers. If you've been watching AVGO recently, this is an episode you need to hear all the way through. Hello everyone, this is Stock Market Breakdown. Today we're talking about one company only, Broadcom, AVGO. Lately the stock has confused many investors. AI orders keep growing, but the stock has seen a sharp pullback. That's why some are questioning whether the AI trade has peaked. I'm not discussing short-term moves or giving advice. I just want to answer one question: is AVGO being wrongly sold off, or is the market repricing it? The recent rebound in AVGO is actually very telling. After a clear period of downside pressure, the stock started to recover quickly, with consistent buying showing up both during regular sessions and after hours. This wasn't a simple emotional bounce. It looked much more like a reassessment of risk. A lot of investors fixated on one issue: the company guided gross margins lower. What largely got ignored is why those margins are coming down. It's not because demand is weakening. It's because custom AI business is growing so fast that it's outpacing the rest of the company. Broadcom is shifting from selling high-margin individual chips to delivering full AI systems and rack-level solutions. In the short term, the transition compresses percentage margins, but in absolute terms, it expands total profit dollars and free cash flow significantly. The market initially reacted to a fear, but the real change wasn't demand or execution, it was the business mix itself. That's exactly why I think judging AVGO purely on whether it looks expensive or cheap misses the point. If you still think of Broadcom as a traditional semiconductor company, any margin compression naturally feels alarming. But once you recognize that it's transforming into a system-level supplier for AI infrastructure, these fluctuations need to be understood through a completely different lens. Another line that continues to be underestimated is VMware. Even now, many people still treat VMware as a passive acquisition and assume it slows Broadcom down. The reality is the opposite. VMware has been fully shifted to a subscription-based model and integrated into VMware Cloud Foundation, giving Broadcom an extremely stable, high-margin, and predictable cash flow stream. This matters because when AI hardware orders fluctuate, AVGO isn't fully exposed to the cycle. Behind the hardware business sits nearly $27 billion in annualized software revenue that supports the entire valuation framework. That kind of downside protection simply doesn't exist for most AI hardware-focused companies. That's why you're seeing something interesting develop. On the surface, the market appears obsessed with margin changes, but underneath, institutions are reassessing the company's overall stability and its ability to absorb volatility. VMware's presence materially reduces Broadcom's dependence on any single cycle, and that has major implications for long-term valuation. From a trading perspective, this shift has already shown up in behavior. During the sharp sell-off, volume spiked aggressively, which is classic emotional capitulation. In the days that followed, the rebound came with much more controlled volume, showing steady absorption rather than chase buying. More importantly, dark pool and institutional flow data suggest capital wasn't entering at highs, it was being deployed during fear. That type of positioning usually only happens when long-term orders and revenue visibility are extremely strong. Broadcom's AI backlog, now exceeding $70 billion, is the foundation of that visibility. This is also why a price-to-earnings multiple around 71 times doesn't look as extreme as it might at first glance. When a company has already locked in most of its AI revenue for the next year and a half, valuation becomes less about sentiment and more about discounting certainty. Zooming out to the industry level, Broadcom is increasingly becoming the core architectural partner for custom ASIC design. More leading companies are moving beyond generic GPU purchases and are instead co-designing their own PAs and accelerators with Broadcom. Once that architecture is embedded into a data center's foundation, switching costs become enormous at the same time. As clusters scale beyond hundreds of thousands of nodes, the network itself effectively becomes the computer. At that scale, efficiency is determined by switching and interconnect performance, which is exactly where Broadcom has built its long-term advantage. So what you're really seeing right now is a clash between two perspectives. Retail investors are reacting to margin compression and short-term volatility. Institutions are focused on architectural lock-in, order visibility, and durable long-term cash flow. The gap in understanding is what keeps creating volatility. Risks still exist after a high-level pullback. Technical supply often lingers, and competition is clearly intensifying as NVIDIA and AMD push deeper into custom silicon. But Broadcom's advantage is that it's already a full cycle ahead, with a strong cash position and a software business that generates stable cash flow. Broadcom is better positioned than most peers to survive any cooling phase in the industry. If you step into the institutional mindset, you'll notice that what's most often underestimated about Broadcom isn't any single quarter's earnings. It's the company's ability to operate across cycles. During rapid AI infrastructure expansion, growth is driven by custom chips, networking, and interconnect. When momentum slows or enters digestion, software subscriptions and recurring cash flow help support valuation. That kind of structure is rare among semiconductor companies. When you place custom AI ASICs, networking silicon, and VMware subscription cash flow on the same map, it becomes clear that Broadcom's revenue model isn't dependent on a single spike. Hardware raises the ceiling, while software supports the floor. This is why Broadcom isn't discarded by valuation models. The way pure hardware companies often are during downturns, the market's current fixation on margins is largely a short-term surface issue. The real drivers of valuation remain order visibility, customer lock-in, and how resilient this business model is across different cycles. So if you ask me where AVGO stands right now, I wouldn't say it's perfect, and I wouldn't say all risks are gone, but I would say it's moving from being misunderstood by emotion to being re-evaluated through structure as the market shifts its focus from margins to order visibility and architectural positioning. The valuation logic itself begins to change. This is Stock Market Breakdown. I'll see you next time.